Something is happening behind the scenes on Wall Street, and you need to know about it. The New York Fed just held an unscheduled confidential meeting after big banks were suddenly forced to borrow over $50 billion dollars in a single day. This is a major warning sign, signaling that a liquidity crisis could be brewing just under the surface. In this video, I'm going to walk you through the numbers and explain what this really means for the economy and for your money. What we're seeing looks like the early stages of a cash squeeze, and the officials in charge seem to be trying to keep a lid on it. But the data tells a story, the financial system's plumbing is under strain, and emergency tools are already being used. Stick with me, because understanding this is crucial. All right, let's get into what just went down. This isn't just another boring financial headline. This is a flashing light in the engine room of the financial system, the New York Fed, which is the arm of the Federal Reserve that deals directly with Wall Street, called a secret meeting. Why? Because the banks that our entire economy is built on were suddenly desperate for cash. How do we know? We can see it in the numbers from something called the Fed Standing Repo Facility. It sounds complex, but you can think of it as a sort of high finance pawn shop for banks. It's a place where they can post their best assets, mostly US government bonds, as collateral to get cash overnight. Normally, banks lend to each other to settle their books. Going to the Fed's official window is supposed to be a backstop, a last resort to make sure the system doesn't freeze. Well, that backstop just got hit hard. In a single day, banks rushed to this facility to borrow a massive $50.35 billion dollars. To give you some context, that's the highest amount ever borrowed from this facility since it was made permanent in 2021. This wasn't a small hiccup. It was a clear signal that the private markets where banks normally get cash were either too expensive or simply not working. Banks needed cash so badly they had no other option but to run to the Fed. And it wasn't a one-off event. That $50 billion warning was followed by another $22 billion in borrowing just a couple of days later. This shows it wasn't just some random glitch. No, this points to a persistent shortage of cash in the banking system. When the private market starts to seize up, the Fed is forced to become the lender of last resort. The fact that the meeting to discuss all this was held privately tells you how seriously they're taking it. They might hold confidential meetings, but the data is out there for everyone to see. Let's look at the evidence that paints a clear picture of the stress that's building. The first thing to watch is the Secured Overnight Financing Rate, or SOFR. This is the main interest rate for the repo market. It's what banks pay to borrow cash overnight using government bonds. You can think of it as the bedrock interest rate for the whole financial system. Lately, that rate has been showing signs of real strain. It has been climbing, and the spread between SOFR and other key Fed rates has widened, which means banks are having to pay more for cash. This isn't happening because the Fed is officially hiking rates. It's happening because there's a scarcity of cash where it matters most. It's the market itself telling us that liquidity is drying up. So, why now? A primary driver is the Fed's own policy, quantitative tightening, or QT. For the past couple of years, the Fed has been shrinking its balance sheet after creating trillions of dollars. They've been pulling that money back out. Their total assets have dropped from a peak of around $8.5 trillion down to about $6.25 trillion. That's over $2 trillion of liquidity removed from the system. For a while, it seemed fine. But now we're seeing signs that they may have pushed too far, draining so much cash that the system is no longer abundant with reserves. This was essentially confirmed when the Fed's Open Market Committee announced it would stop shrinking its balance sheet as of December 1st, 2025. This wasn't a random decision. It was a direct response to the very stress we're seeing now. On top of that, the US Treasury has been issuing huge amounts of new debt to fund government spending, which also soaks up cash from the market. You have the Fed pulling money out one side, the Treasury pulling it out the other, and the banks are caught in a squeeze. We've seen the problem and the data, but what does a liquidity crisis actually mean for you? Think of liquidity as the oil in the economy's engine. The engine can be perfectly built, but if you run out of oil, the parts grind against each other and the whole thing can seize up. Cash is that oil. Right now, the oil light is blinking. A liquidity crisis tends to happen in stages. It starts where we see it now. In the short-term lending markets, banks get nervous about lending to each other, wondering if they'll get paid back. This is called counterparty risk. So they start to hoard cash and stop lending. That's when a credit freeze can begin. It's not just banks that are affected. Big companies rely on short-term credit for daily operations like making payroll. When those credit markets freeze, that funding can vanish. This can lead to the next stage. Forced selling. If a big fund or bank needs cash and can't borrow it, it has to sell assets. They'll sell what's easiest to sell: stocks and bonds. This isn't selling based on a company's value, it's selling out of desperation. When everyone rushes to sell at once, you can get a market crash that hits everything, including your retirement accounts. From there, the problem can spill over to the broader economy. Companies that can't get funding may start laying people off. Car loans and mortgages can become more expensive and harder to get. Economic activity slows down. And what started as a plumbing issue in the financial markets can become a real recession. This sequence has echoes of past financial crises, and some analysts are already warning that what we're seeing now are the dynamics of an early stage credit freeze. If this is so serious, why isn't it the top story everywhere? The answer has a lot to do with the Federal Reserve's unofficial job: maintaining public confidence. Think about it. Why was that meeting held in confidence? If the Fed sent out a press release titled Emergency Meeting on Liquidity, it could cause a panic. And panic can become a self-fulfilling prophecy. If everyone thinks the banks are in trouble and pulls out their money, the banks actually get into trouble. So, the Fed's natural instinct is to project calm and control, but their actions can speak louder than their words. Holding a confidential meeting signals their level of concern. There's also the issue of stigma. Banks are often reluctant to use the Fed's emergency facilities because they don't want to be seen as weak by their peers. So, when we see a massive $50 billion draw, it suggests that for some, the fear of running out of cash outweighed the fear of that stigma, a sign of real pressure. This is all happening during a period of leadership transition at the Fed. Fed Chair Jerome Powell's term is approaching its end, and Atlanta Fed President Raphael Bostic has announced his intention to retire in 2026. Other governors have also left. This creates uncertainty at the very moment strong leadership is needed most. With leadership changes and increased political scrutiny on the central bank, questions arise about who will navigate this potential crisis and whether they can act independently of political pressure. This institutional flux adds another layer of complexity to an already tense situation. So what happens next? The Fed has already been forced to make a defensive move. The decision to end the balance sheet runoff on December 1st is a big one. They're essentially trying to stop the bleeding by no longer actively draining liquidity. The next step, which is already being discussed, could be reserve management purchases. That's a technical term for when the Fed starts buying assets again to inject cash back into the system, a form of quantitative easing, or QE. They would likely frame it as a technical move, not a change in policy. But make no mistake, it would be a reversal forced by instability in the market. Here are the key things you should watch to see if the crisis is getting worse or better. First, keep an eye on the repo rates and SOFR. Also, monitor the daily borrowing from the Fed's standing repo facility. Any new large spikes mean the pressure is still on. Second, watch the Fed's balance sheet, which is updated weekly. After December 1st, the runoff should stop. If you see the balance sheet start to grow again, it means they've likely started those reserve management purchases. Third, pay attention to the banks. Are they tightening lending standards? Are they hoarding cash? This is a critical sign of a system that's losing trust in itself. Finally, listen carefully to how Fed officials talk about the situation. New York Fed President John Williams has already tried to normalize the use of the repo facility, saying he expects it to be actively used as reserves decline. The more they try to reassure everyone that things are under control, the more important it is to watch the data and see what's actually happening. What we're seeing is a serious challenge in the financial system. The plumbing is clogged, alarms are going off, and the fact that an unscheduled meeting was held suggests officials are deeply concerned. The $50 billion dash for cash wasn't a fluke. It was a symptom of a liquidity problem that has been building for months. This is a developing story. The decisions made over the next few weeks and months could determine whether this is just a tremor or the start of something much bigger. The pieces are in place for more volatility. If you want to stay on top of this and understand the real story behind the headlines, make sure you subscribe and turn on notifications. We focus on the data to show you what's really going on with the economy and your money. This is not a time to be in the dark. Share this video with people you know who need to understand the risks building beneath the surface. Stay vigilant and stay informed.